all these kind of fun things. All right, we're in MLO Network. We got about 10 or 11 folks watching us. We had committed to talking about working with more financial pros. What does that mean, Kai? Financial pros. We say financial pros, like
financial planners, insurance agents, not property and casualty, but like life insurance agents and accountants, CPAs.
Okay. So
it is very important we diversify and we add them to the mix and not just go after realtors.
Okay. Now, traditionally for years, we've heard about adding these pillars to our business, and a lot of people have told us we have to do it. Your big thing lately has been trying to help LOs figure out how to be more modern about how they connect with people.
Right.
More modern way to connect with financial planners and CPAs and all those types of professions as well.
Well, I think that when people think of the term modern, they immediately think of like modern, like technology and things like that. When I talk about modern, I'm just talking about the modern age, like what's relevant today, right? It's like modern rap or modern music. It just means what is relevant today. And the problem is that a lot of the industry is rampant with continuing to use strategies that worked 5, 10, 15, 20 years ago instead of looking at what works today. So the modernization of your business is understanding what works today, right? So there are some obvious reasons why we should work with financial planners, or let's just say financial professionals, because it includes advisors, accountants, CPAs, and insurance agents. So some of the obvious reasons are diversification. Do you want all your eggs in the realtor basket? Because remember, when you work with real estate agents, you're working a buying cycle. You're working an interest cycle or a buying cycle. So a buying cycle of, are people buying? Are they not buying? Interest rates, are they high or whether they're low? When you're working financial professionals, they're not on that cycle. They're on a life cycle. So when you're a financial advisor, when you're an insurance agent, when you're a CPA, these people are helping them with life events. They're helping them prepare for having a family. So they're helping them save money. So their life events are getting married, having kids, buying a house, preparing for retirement, getting divorced, planning estates. So if you're 30 years old, you're generally in that age bracket to get married, plan a family, and to buy a house. It doesn't matter what the market's doing. It doesn't matter whether the market's 7% or 4%. When you're 30 years old and you get married, you want to buy a house, you're going to buy a house. You see what I'm saying? It's like, if you're getting divorced because you're 40 years old, 45 years old, getting divorced, then you're going to have to sell your house and buy a new house at that time. Everything is not based on this cyclicalness of what's going on with real estate and what's going on with interest rates. It's going on what's going on with life. And so you follow a different cycle when you work with financial planners, which is actually almost irrelevant to what the market and what interest rates are doing. Okay. So that's some of the obvious stuff, but what is some of the like not obvious stuff? One of the big issues that we have with the current modern market is we have a lack of inventory, a gross lack of inventory. We only have 25% of the inventory of the past 10 or 20 years. So what does that mean? Extreme competition. Now, if you look at the generations, because I always look at how the generations fit into today's buying cycle, you have boomers, Gen X, millennials, and Gen Z. So which generation is buying the most houses right now? I'll let you take a guess. Which generation is the most houses? We're Gen X, the boomers are a little older, millennials are the biggest generation, the younger ones, and then you have Gen Z just coming up, which is like 26 years old.
Now you got me on this a couple of weeks ago, and I wish the crowd that's watching would comment or put some stuff in the comments. Maybe I should just start doing meetings instead of Zoom so we can put my camera. But I at the time you first asked me, I guessed just like Esther here, I guess millennials.
Millennials, right?
Quickly corrected me and said, "No, that's
boomers,
not right." So I was like,
"Oh,
it's got to be my generation."
Surpassed millennials.
Nope, it's not. It's
boomers just surpassed millennials for different reasons, right? So you would think it's millennials because millennials are between like 27 and 40 years old, so they generally make up the biggest housing market, because you've got young families, you've got first-time home buyers, you have people basically entering the market. You also have the late millennials. So the millennials that are like 40 years old, they should have bought when they were 30, 35 years old. But remember, because of recession and because they really couldn't get their careers off the ground, which was very rampant of the millennial generation, they're finally buying. But why is it that the boomers now are all of a sudden buying, especially when you would think that the boomers are established and they don't want to move. Well, the boomers do want to move. And what's happening with a lot of boomers is that they're moving to different markets because they want to get out of big cities, big metro cities, and want to go to smaller states. But one of the reasons why the boomers are actually making up the most home buying is that the key word is that they're winning the most offers because they're move-up buyers. So they have the most equity to outbid everybody. They have the most equity to outbid everybody. And that's a substantial statistic. And that's why if you look at like last month's home buying statistics, I think 40% of last month's home buying sales were like cash only. So that leaves 60%. So like out of the 60%, what percentage of that do you think are the three? I mean, everybody here is a loan officer. Ask yourself how hard it is to get a 3% loan, a 97% LTV loan offer accepted when you're going against 15, 20 other offers in the market. Right? When you got a move up buyer who's got 20, 30%, they can handle an appraisal gap. They can handle maybe a $50,000 overage, right? To outbid. Well, that's coming from boomers, people with equity. Now, Gen X is doing that too. Like we're Gen X. We're just a smaller generation. But my point is that who's winning all the offers? When I ask people like, oh, well, I've got 30 people pre-approved, but I can't win offers because people are outbidding me by 20, 30, 40, 50,000. That's not first time home buyers doing it. Matter of fact, I talk about this all the time that like, can you really look at somebody dead in the eye today and say it only takes 3% to buy a house? We see a lot of videos that say it doesn't take 20% to buy a house, it takes 3% to buy a house.
I actually think everybody talking about 1%. The big.
Oh yeah. The reality is it still takes 20% to buy a house because you need 3% for the down payment. You need like 5% for closing costs. And then you need like 12% to overbid and to possibly cover appraisal gap. So it's, it's just strange marketing. And I know what we do. We're an industry that we like to market demand. So we like to create a lot of demand, but we don't have enough supply. And so you have to understand supply, right? So if you look at the boomers and you look at the people that actually have money, that actually have assets, financial professionals work with people that have assets. To be able to afford a financial professional, you're generally somebody who has assets that you're working with a financial planner to advise, you're working with a high-end accountant, you're working with a CPA, or you're working with an insurance agent. And so they're great referral sources because they have better qualifiable people with assets that can win in today's modern market, which is low inventory, high competition in offers. Because we have a very, very delicate market right now. It's like you're either above 6%. And here's the thing, if you're above 6%, well, generally buying sort of like slows down because interest rates are high. But again, not for somebody who's getting divorced, not for somebody who newly got married and they want to buy a house, right? So we have to look at supply. And then if you're under 6%, there's a frenzy, and then you're gonna have 27 offers on a property, right? So that's the market. It's very, very delicate. It's either here or there. Not like before, we can have this perfect mix of like houses available, there's good demand, interest rates are 5%. Like those days are gone when you have a supply shortage. So we're down 75%. So we have to look at going after financial professionals.
The whole concept of household formations, being delayed for almost a generation, then all of a sudden they started again, but the builders post 2008, spent 10 years going slow because they were worried, concerned, and conservative. And so there's just such a gap there. And, but
right.
So what do you think for the buyers that are going low down? I mean, I know like a lot of folks in my veteran mortgage advisor community, we're telling all the folks they can go zero down, they can get money from the seller, all these kind of things. And they're still out there trying to get their offers accepted. And I find it's kind of a delicate dance.
It is delicate. And I would say that's probably either another topic or that's just the reality of they're going to buy or they're not. What I want to talk about today is like going after financial professionals where they have referable clients of people with assets, because that's what we're looking for. We're looking for people that have 20% down, 40% down because they're move up buyers. And so how do you go after financial professionals? Well, first of all, there's three types, right? And if you want to go after them in order, I would go after them you would go after them in this order. Agents first. So insurance agents, not property and casualty, but like insurance agents, and then accountants, and then finally financial advisors. And they all have different needs and they all have different demands in what they're looking for and what they're looking to partner with. So first of all, when you partner with a financial professional, they're different than real estate agents because you're a financial professional. So they relate to us a lot better. Their professionalism is a lot better. They look at money like we do. They're not just trying to sling houses, So what is, for example, an insurance agent, what are they looking for? It's really easy for them they're looking for cash flow because it only takes as little as $100 a month to fund an insurance policy, right? Or 200 or 400, 500 to fund like a universal insurance policy. But even if you wanted to fund a small term life policy. And so insurance agents are looking for cash flow situations. And so if you can explain to them that as a lender, that you know how to guide your buyers in making better financial decisions, which frees up cash flow, especially if you're working with higher net worth people. It's like, why put this much down when you can put less down and free up some cash to fund an insurance policy? Or why put this much down when you can pay off debt to increase cash flow to fund this policy? So everything around the angle of working with insurance agents is by making the smart lending financial decisions, we can free up more monthly cash flow versus a buyer that's thinking to themselves, I want to pay off the house faster. I want a shorter term faster. I want to put more money down, which is a lot of times conventional wisdom. Okay.
I see a
And
lot
so
of the
that's the angle of insurance agents.
and I see a lot of LOs out there treating that relationship the same way they kind of see the realtor LO relationship, in that they say, well, I just, all these insurance agents calling me and they just want my leads, but they never give anything to me.
Right.
So,
right. And so you have to figure out right. You got to figure out what they're looking for. So insurance agents are looking for cash flow. So if you're going to call them for looking for business, you're saying that you want to help people build wealth through insurance. Now, what is the biggest opponent of wealth is debt. I manage the largest debt anybody's going to ever have. So if I can help them manage that debt better, where they can still buy the house, but increase their cash flow even by $100, $200, $300, $400 a month. Remember, we're talking about their clients that have more assets, right? Then they can fund an insurance policy better with you. Okay. And it seems obvious, but it's not. I mean, we've been in this industry for a long time, and there's still a lot of conventional wisdom. If somebody's going to sell a house, they're going to take the profit. They're going to think, I'm going to put the maximum into that next house. But it's like, no, you can carve aside maybe $20,000, pay off that debt and increase cash flow, or even slither an extra $10,000 and pre-fund an insurance policy, right? And so these are the things that when you work with insurance agents, you let them know that that's your thought process of minimizing people's debt or minimizing people's cash flow, but still letting their clients still obtain the house, but then also fulfill the longer term need of funding that long-term retirement insurance plan too. So that's the first category.
Well, just like you talked about a couple of weeks ago, you can get on the phone and you can talk to these people back and forth, but if you don't actually have some slides or some pieces or presentations to show them, it doesn't seem as modern. So you're not going to get as much out of the relationship if you're just dialing for dollars.
You're right. And so one of the things is, and I'll talk about the actual strategy for dialing, but if you're going to talk about that stuff, it would definitely behoove you to have slides that you can show them, because, this is modern society. So I can set up a meeting with an insurance agent and just do a Zoom meeting. I don't necessarily have to go for coffee. I can set up a Zoom meeting. And with the Zoom meeting, I have the advantage of showing some slides. So if I can show some case studies of how we had some buyers and how I repositioned their liabilities to increase cash flow, or even, Barry's talking about maybe a mini refi boom on May 10th, because that's when the next inflation numbers come out, right? So what if we have a mini refi boom? What are people going to do with that savings? If I can express to an insurance agent that savings can then be reapplied into insurance. And so if you're going to use debt consolidation reports, whether it's MBS Highway, whether it's Mortgage Coach or your own personalized spreadsheet, if you can show case studies or you can show potential studies of how you can help their clients in a modern way on Zoom, on a Zoom share, then you're going to connect with them. And it's not just talk. Okay. So that's that category. The next category is accountants and CPAs. Now, accountants and CPAs are really interesting. So I'm not talking about the accountant that prepares your $150, H&R Block tax return at the end of the year. I'm talking about real CPAs, accountants that manage self-employed borrowers, businesses, payroll, bookkeeping. They manage a higher level of borrower. And again, these high level of borrowers are generally more affluent. They're going to have more assets for buying homes and in terms of qualification. And so what is their busy season, right? Their busy season is like usually the end of the year, like from November to May, because that's tax season. So when is their down season? Their down season is between June and October. So what are they doing in the down season? Not much.
They're playing golf.
And a lot of these, But a lot of these accountants, they work on billable hours. They do billable hours. And so they're looking for something to do. So if you approach them and you say, hey, I'm a holistic lender, I'm a liability advisor, and we do annual reviews. Okay. And we look at we look at people's cash positions, equity positions, we look at their payoff positions, and we do that. Do you have clients that we can do an annual review for? Accountants are going to say, yeah, let's do it. We got nothing to do. I would love you to review my clients. I can send some clients for you to review, because they're looking for excuses to create more billable hours and to work with their clients as well too. And that's something that they want to hear. It's like, okay. And they're constantly, if you've ever approached an accountant and they didn't have time for you, it was probably because it was between like November and May. But they have all the time in the world to talk to you between June and October. And so you have to look at them as a cyclical cycle as well too. So that's, I know it's already it's April. It's only April, but in about 45 days, they're going to have this time that they don't know what to do themselves. And they're going to be primed for approaching. And the greatest thing about financial planner referrals is if your CPA says, use my lender, 95% of the time they're going to use the lender. They're not going to shop you. They're not going to do anything else. Because these are the people that manage your money, and to a consumer, they're going to be like, I'm going to use the person that you recommend because I trust you to manage my money. I'm going to trust another person to manage my money. And so that's a different category.
I've also found that with the CPAs, if you can try to help train them to add that one question to their annual reviews or their tax prep reviews, that one question about buying a home, and making sure that they've consulted with their mortgage person if they're planning on buying a home with this year's taxes, in the next 6 to 9 months. Are you planning on buying a home? If so, the way we're doing your taxes, have you consulted with your mortgage person? Because I know we've done a lot of write-offs. And if you're
and tax accountants, they're built a little differently, because they'll look at you like, oh, you have too much income. How can we put this into a house, right, to get some tax deductible interest? So they're looking at it a little differently. Tax accountants actually tax accountants and loan people are kind of like opposing forces, because we want to spend and expense as much as we can from the tax side, right? But like I said, you can work in unison with them. So those are really, really great referral sources. And again, I haven't discussed how to approach them, which I'll talk about in a second. But know that that's a different animal with a different need, and their need is literally to provide. See, here's the thing about a CPA. CPAs want to feel like they're more valuable than just doing tax returns and bookkeeping, because if they can feel that they can actually give some type of financial advice, then the rates that they're charging feels justified to the clients.
Just like us loan officers.
Right, exactly.
I want a shirt that says I am more than a rate.
Right, exactly. So that's how CPAs are, versus an insurance agent who just wants an extra $150, $200 a month. So finally, you have financial advisors. Now, financial advisors are interesting because they're really they're not really wealth managers per se as they are relationship managers, because financial advisors, they don't really manage your portfolio. Okay. The financial houses do, but they're really relationship. They're here to create relationships with people and to talk them through their life cycles. And so when you approach financial planners, you just have to express to them that you are also a holistic relationship based person, and that how you do annual reviews, you watch the market, you look at their loan setup, you advise them when to pay off their mortgage, not pay off their mortgage. And then you tell them that, there's a 6-person wealth team, which would be your insurance agent, your accountant, your financial planner, your loan officer, your realtor, and your attorney. That's 6. If you include an estate attorney, that's 7. And so approaching a financial advisor and saying, you're a part of that team who sees like the big overall in terms of a client's life cycle. And I'm not just a lender that throws another debt and just wants to sell a home. I'm a liability debt manager, and we need to work together. They're going to work together with you because of the relationship. They're not necessarily looking for a gimmicky angle of cash flow or or tax savings. It's just more, they want you on the team, and when you're necessary, they're going to give that advice to the client and refer you, and vice versa. Okay, and that's a different beast. And then with those guys, there's 2 levels, because obviously you're going to have the ones that are managing like the boomers and the Gen X money, but there's the up and comers that are still managing the brand new first time home buyer. Maybe they don't have a lot of assets, but they have high income, so they have a lot of potential. And just like how real estate agents and loan officers, we tend to, when we first start, we tend to grind for like the really shitty deals. You know what I mean? Well, that's how financial advisors are. When they first start, they start with the people that don't have a lot of assets, but they got a lot of income. And so they're helping, the younger generation into a longer term portfolio. They'll take all that business, while the older advisors, they're generally working with more established people. And so know that you're going to be working with two levels there. Okay. But they're relationship driven. They're completely relationship driven. So their approach is that.
I found some of the older advisors, I mean, they already kind of have mortgage relationships. And in some cases they've opened up their own brokerage or what have you. The last couple that I've approached through different connections have actually had, their own broker's license. And of course they send like everything to UWM or what have you. And they don't really know what they're doing as loan officers, but they're not quite as approachable. So, like for me,
yeah,
well,
it's, I mean, that's I guess
of,
that's the same as somebody that already has their preferred lender, right? And it's a matter of, you're either going to try to, you're going to try to override that relationship and express to them that you're actually more versed in not just the relationship side, but the management side of liabilities. And I'm not just a lender, but because I'm the in-house lender. And I mean, a lot of those relationships, they just kind of have an in-house lender. But what happens is that they just throw it to some in-house lender. It's just some loan officer throwing a loan program and low rate. They don't actually have a relationship with that financial
you got to show them that it's more than transactional,
right. So I think that you can
I'm building a
bypass
local,
that and show them.
yep. I'm building a book
Exactly.
just like you. Like you're out here in the community meeting people just like me, and we're building a book just like you're building a book. So
right. And that's why I say it's relationship based, because you're right. A lot of them may have that connection with like, they're like with Edward Jones, and all of a sudden there's an Edward Jones, mortgage division, but it's not. It's really it's really, XYZ mortgage company that's attached, and it's some random loan officer that's getting paid leads or however they figure it out, but they're not really in the relationship, and they don't really understand liability management. They're not really going toe to toe with not toe to toe, but they're not conversing and being social with that financial advisor on a regular basis. And so that they're looking a little bit more for that. And then you have divorce attorneys, which aren't financial professionals, but I mean, more than 50% of people get divorced. And so there's a situation there. Right. And I think that being able to approach divorce attorneys and say, I understand the intricacies of getting in and out of assets, or, what are we going to do? Are we going to sell the asset? Are we going to cash out the asset? Are we going to sell the asset? Are we going to sell the asset and end up with nothing? Are we going to sell the asset and end up with one new property? Are we going to sell it, end up with two new properties? Are we going to keep it, cash out, end up with two new properties? You know what I mean? Like what are we going to do? And if you can show that you're the loan officer with case studies, with mortgage code sheets, with MBS highway sheets that show like the different case studies, how you've helped creatively help people through the divorce and basically split an asset. Because I mean, how many like credit union loan officers are going to have that capability? Right. And and can put the sheets together.
Jody does a great job with that, with her divorce lending program, and getting in front of that and being able to talk to these people from the perspective of, just like we've been talking about, from the the seat of a financial person, not the seat of a salesperson. Learning how to pull yourself out of the transaction, how to pull yourself out of the sale of it, and become valuable as an advisor. Teaching those attorneys and even these financial planners to think of questions they didn't think about upstream, and to get them to talk to you upstream of the decisions that are actually being made, to show them how important it is to consult with a good mortgage person on the markets whenever they're talking to their clients about those decisions before they get too far in the process.
And I think we're kind of gated by how much resistance we get from from realtors. Mm-hmm. The fact of the matter is that when you have these conversations with financial planners, they're extremely easy to talk to. And even in the moments where they do have somebody that they work with, you can still have an analytical, intelligent conversation with them. And they're still very like open-minded to, to your, just to your mindset of approaching them, which we don't get that a lot from real estate agents because they're always brushing this off. And so I don't want there to be, not only do I want there to not be a fear of people approaching financial professionals, but once you approach them and you realize it's like when you go against realtors, especially top realtors, it's like you're playing the video game on hard mode, like on 8, and all of a sudden you approach financial professionals and you go down to easy mode in terms of approach. And you know, I know in the past people are like, well, I've worked with financial planners in the past, but they don't give me as many referrals. Realtors right now, they're not giving very many referrals either. And if they are, they're generally giving referrals that either don't qualify or they do, but nobody's winning because it's a qualifiable loan, but it's a barely winnable loan. So when you really look at the numbers, financial professionals really give us quality loans at a pretty good rate in today's modern market.
Well, and if you have the well-rounded sources, sometimes the financial planner gives you a person that's not represented by a realtor and allows you to walk in with that piece of gold that realtor has been asking you for forever. So,
right. So here's the strategy. Here's like the gold strategy. And I've been using this strategy for over 20 years. This actually made up by my mentor. Tim Brahim is my mentor, and he showed me this strategy 20 something years ago. Where you start is you start with your database. That's where all the gold is. You start with your database. That's how actually I start. I'm actually known as a database person. You start with your database, and what you do is you start with a certain, you're going to call everybody in your database, and you're going to call every single person in your database. And what you're going to ask for is you're going to say, I'm always getting asked, what you tell them is you say, I'm always getting asked for a referral to a financial professional. My clients are always looking for good CPAs, good attorneys, good accountants, good insurance agents. So I want to ask you, do you have an accountant, an insurance agent, okay, CPA, an attorney, financial advisor, et cetera? And how would you rank them on a scale of 1 to 5 stars? By the way, back in the day, we used to ask the term 1 to 10. But you notice I've changed all of my language descripting to 1 to 5. That's because in today's modern world, we think of 1 to 5 stars in terms of social media reviews, Uber reviews, and everything. So we think a little bit more 1 to 5 stars, like 3.5, like we'll say 3.5 stars versus we would say 7. Now we just say 3.5 stars. So what I'm looking for is I'm looking for them to say, I love my financial advisor. He's 5-star. I don't like my accountant. He's 2 stars, right? Okay. So what you're going to do is you're going to make a list. You're going to make a list of all the people that said 3.5 or less. Okay, 3.5 or less for a certain category. So if you have John Doe that says accountant, he ranks them 3 or 2. You're going to write that down. Accountant 3 or 2. Don't even need the name. You just know that they rank their accountant 3 or 2. They rank their insurance agent 3 or 2. They rank their whatever 3 or 2. And then for everybody that says 4 or 5, you're going to put that, but I want that person's name and I want that person's phone number. I want that financial advisor's name and phone number. Because for the 4 or 5s, what you're going to do is when you're done calling your database, you're going to have a list of like 100 4 or 5s and like a couple hundred 1 to 3s, 1 to 3.5s. Okay. Now you can easily call the 4 or 5s and say, Mike, my name is Kai McBride. I'm a loan officer for XYZ Mortgage. We have a mutual client. And I have a lot of clients that are looking for good insurance agents. And when I surveyed my clients and I asked TJ, he raved about you and rated you 5 stars. I want to tell you a little bit about what I do and why, and you go on the script, but it's basically like, as somebody who manages, I don't see myself as giving somebody a mortgage. I see somebody as managing liabilities, and knowing that you are an insurance agent. If I help them manage their liabilities better, I can help free up cash flow better so we can work together, whatever the angle is, right? But it's such a warm script because we have TJ as like the mutual client. It's a really, really easy conversation. And better yet, when I surveyed my database, I have a list of 47 people that were not happy with their insurance agent that I would love to at one point, hopefully introduce you to. Everybody can do this now with their database in the next 3 months, which goes back to the need of, have you been managing a database? Have you been accumulating a database? If you've been accumulating a database of at least 500 people, this is gold. You're going to call 500 clients and you're going to have a list of, like I said, at least 200 potential financial professionals that are ranked 4 to 5 stars, that are leads for you, warm leads for you, and at least several hundred that don't have it. And then depending on the makeup, whether they're first-time home buyers, you want to match them up with the maybe more junior advisors that will take that on. Then, your senior advisors that will take on the more higher asset clients. And you can do that. You play that match game all day and you can probably pick up 5 to 10 financial professionals just doing that alone. And it's probably the easiest database conversation that you've ever had. And by the way, it's a similar conversation because I know a lot of people that got their start or did a lot of their business in the refi boom. So they never really did a purchase with somebody. It's like calling them up and saying, by the way, when you bought your house, did you love your real estate agent? Rate them on a scale of 1 to 5. They rated 5, then you call the real estate agent and say, I'm always looking for real estate agents to work with, et cetera, et cetera. You were rated about rate of 5. I would like to get to know you. Same thing. Like there's so many referral partners in our database. If we just ask our clients, and we'll know who doesn't have one.
Is it so much more fun asking that question than like asking, hey, are you going to buy another house? Is your next door neighbor going to buy? Is your kid going to buy? Are you going to call me when the rates go down 2%? I mean, that again.
Well, that conversation alone, they'll probably, while they have you on the phone, they'll say, by the way, what are rates doing or what's going on with the market? And then you just open them. So you can have a conversation about maybe potentially they want to buy another home, refinance, take some cash out to buy an investment property, something, because you're calling for something else.
But you're positioning yourself like a financial person. And, this a lot of these calls, we come back to this, positioning yourself as a person who gives good advice, who helps manage debt, who helps build wealth, as opposed to positioning yourself as a salesperson,
right.
And structuring the questions that way, even though
they're going to look at you different because now you're calling them talking about financial management. So they no longer see you as just a loan officer. They see you as
part of that team,
as a financial advisor, part of the team of 6, right? Because you're not even calling for that. Oh, by the way, how's everything? How's the house? How's the payments? How's the kid?
You guys ready to get divorced yet? How's that going?
Yeah, exactly.
I noticed you're fighting at the closing table,
I mean, and it's kind of funny because if you say, I'm looking for a divorce attorney, and I say, I know it's a really awkward question because I'm not saying that you've ever been through divorce, but maybe your brother or sister knows somebody, and I don't know, maybe they'll open up to you and they'll say, well, I mean, I know this is sad statistic, but I bet you if you called 500 people, 50 of them might say, well, it's funny you called because we're in the middle of that now, and maybe you can help me. That happens too. And then you have your estate planners too, which is like another category. And like how many people's houses should be in a trust? Like everybody's, you know what I mean? Like how many people with a kid need a will? Like everybody. So that's a great referral. And so
nobody knows
every estate planner has a client that has a property.
And nobody knows where to go for a trust. Like literally nobody. You ask people, like, I don't know. Nobody seems to know.
Yeah, nobody knows. But we're so obsessed with chasing real estate agents. We're so obsessed with playing in the red ocean. This is the blue ocean strategy. The red ocean is where all the sharks are feeding, blood's everywhere, and the blue ocean is where people aren't swimming. And I realize that what we're talking about has been talked about for years. This. It's been talked about for 20 years. But the difference is that in today's market, we don't have an abundance of inventory. So higher asset clients are winning. And who has the highest asset clients? Financial professionals. So it's a very modern strategy because it's a modern scenario that you have to recognize.
I love it.
And so you have to do that diversification.
So modern strategies, you've been teaching, and I know this is like not about how cool Kai is or how cool these seminars are, but you've been teaching people all about transforming your business to be more modern, to evolve or die has been what we've
basically evolve or die. One of my favorite authors, Trevor Moawad, he wrote a book called It Takes What It Takes. And the reality is that you're going to do what it takes or you're not going to make it. That's it. I mean, you can sit there and you can stay in denial but how many people are staying in denial and they're just watching their pipelines fizzle or they're just they're just starting to feel less relevant every single day. And so that's why I say you have to evolve or you're going to die. And it may not be a quick death, but it could be a really, really slow death. And my webinars, as a coach, I don't always ask people to work with me permanently, but if you can just attend my one webinar, I guarantee you it'll change the way you look at yourself. It'll change the way you look at your business because we address a lot of modern issues. And one of the modern issues that we address is like, how many of you are just tired of just beating the phones every single day when there's a lot more modern techniques, a lot more modern marketing techniques to really build your business. And, I'm going to put it in the chat, but this is the link to my webinar. There's actually one tomorrow. It's a 2-day webinar. And if you use the code, either MLONet, if you use the code MLONet, it's $50 off. But it's a very, very small $100-something for you to for 2 hours worth of content that I guarantee you will change the way you look at your business, will change the way. And this is all we talk about, is we talk about the strategies relevant today, because I know there's a lot of you that are thinking, what we've been told for the last 20 years, it works, but it just feels like it's more of a grind. It feels like it's not fitting today's strategy. It feels like you're out of touch with the modern consumer, with the modern competition, with the modern referral partner. And the answer is because it is. Because it is. And you said so yourself, if I'm going to sit with a financial advisor, it's not just going to be talk. I'm going to do a Zoom meeting. I'm going to have some slide decks. I'm going to have illustrations, because we have the technology to do that. And so why not have a modern presentation that shows that, and some video testimonials and whatever that is. We have so many things to our fingertips.
Yeah.
If
you think you don't have the tools, like a lot of people think they don't, and they do. Like I talk to LOs every single day. Oh, I don't have these slide decks. I don't have all this stuff. I'm like, well, do you have MBS High? Well, yeah, we got it. Company account or whatever. My LO next to me has it. Okay, cool. Go in and just
you know what I tell people.
Like there's graphics in MLO net all the time. Pull a couple of those. Like just get some graphics somewhere. They're everywhere.
I always tell people that, can you do me a favor? Can you repeat that conversation, and can I record it? And can I send that to your spouse and tell me what they think about the excuses that you're making? I have a client right now that I've only been working with him for about 2 weeks. And in 2 weeks, he's already had his first realtor webinar that he had 7 realtors on. And he's got an hour's worth of recording, and all the recordings are already sliced up with music and captions and everything now that he can use for marketing and everything else. He's been working with me for like 2-3 weeks. He doesn't have any excuses. You're going to evolve or you're going to die. And like I said, maybe the excuse is okay for you. Maybe the excuse will fly for me. But if I recorded that, how would you feel if your spouse and the people that depended on you felt that excuse? And like I said, it's 2 hours, small 100-ish feet to watch. I'll change the way you look at your business, and I'll change the way you approach your business, because this is all I talk about is modern strategies, modern approach. And like I said, modern does not necessarily mean technology. It's understanding the market. We've been a demand side, task-driven industry, which means we're always trying to create news, trying to create demand, and trying to create behaviors. When we have to turn more into a supply side, which is understanding what is the supply, where is the supply, where's the business coming from, and how do I address this supply, and how do I address the consumers? We have a brand new generation of millennials and Gen Z. But at the same time, as much as we have to adapt to them, the boomers and Gen X are still irrelevant, because we still have the money and the assets. So how do you talk to them differently too? You're going to talk to a boomer generation. It's like, they may not want to get all the little YouTube links and things like that, but a Gen Z is going to want to know, what is your IG account? Because I'm going to follow you before I even decide to work with you.
I'm telling you, man, the boomers in the Gen X still have a lot of influence over those other generations. But what I see a lot of LOs doing is they try to use their influence, their past clients, and they're boomers, and they're just like us, Gen X. They make that connection with the millennials or the Gen Z, but then they lose the deal.
Yeah.
Because hey, can you call my daughter? And they didn't keep track of them long enough. They didn't communicate with them long enough, and they lost them to an LO that was more tech savvy. And,
I just learned like 5 Gen Z.
I'm talking about myself right now, Kyle.
If you want to be relevant, just learn their lingo. Just say like no cap, say Riz, say T, just say things like that. So at least you sound young.
I'm bussing.
Yeah. But that's all I'm about. It's just like, because what we're dealing with right now is going to be around for the next 5 to 10 years minimum, if not just the permanent generations, because pandemic changed everything. The generations that have changed, that changed everything. Like this is not going back to what it was. You have to understand that this is the way it's going to be, and it's going to get better or worse, however you look at it, but it's going to be different. We're moving out of the blockbuster generation, and we're going into the Netflix generation. Right. And even people let Netflix go, and even the young generation, Netflix is like old to them. We're like, hey, we're going out of the Netflix generation. We're going to the on-demand generation. Right. Like everything is going to constantly change. So you got to look at that. So anyways,